it would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because,
Wow.
it's good to be
Yeah.
right. But yeah, but $5,000 is within reach, but $10,000 would just come as no surprise for gold. And there's kind of like a fifth grade math issue here. It's not complicated, but so people think of the dollar price, $100 an ounce for $1,000 an ounce. And let's say you have 50 ounces and gold goes up $1,000 an ounce, well, you just made $50,000. And if it goes up another $1,000 an ounce, you just made another $50,000. So that's true. But people get anchored on the $1,000 benchmark and making $50,000. But what they forget is that each $1,000 benchmark is easier than the one before because you're working off a higher base and it's a smaller percentage. And just to give a concrete example, when you go from $3,000 to $4,000 an ounce, that's a 33% gain. But when you go from $9,000 to $10,000 an ounce, that's only 11%. That's like a good week the way gold's been going. So my point is, you're like, hey, it took a really long time to get from 3,000 to 4,000, which is true. But so therefore it's going to take forever to get to 10,000. That's not true because it'll make its way to 5 or 6, but it's going to go 7, 8, 9, 10 really quickly. So silver's along for the ride. You at that point you're looking at $200 an ounce. I mean that's not even a stretch. The people talk about the gold to silver ratio. You can calculate it. It's just a number. There is no fixed ratio. This goes back to some 19th century lobbying campaign by silver miners. People talk about 16 to 1. That was a political lobbying thing. There's nothing natural about it. Having said that, there's no way gold's going to where we're talking about $5,000 to $10,000 an ounce. The silver's not going to move also, which it will. So $200 silver would be in the same vein as gold going to to $10,000 an ounce.
It just feels like to me, Jim, that silver is almost finally able to shine through and is showing its true price.
Yeah, I agree with that completely. Silver lags. I mean, gold will lead the way, but silver's along for the ride, but it does
Mhm.
lag. But now the lag has caught up and silver's taken on a life of its own. There are drivers of gold. There are fundamental drivers. Now, some of this is momentum. It gets going and people jump in, but we're not at the crazy, momentum stage where, it's a retail outlet. People were lined up around the block. I mean, some places,
Exactly.
but we're not there yet. But there are some really deep fundamental things driving gold. One of them we've talked about before. Central banks are net buyers. That tipping point transition that was in 2010. From 1970 to 2010, central banks were net sellers. Since then, they've been net buyers, but the number of central banks joining in and the amount of net buying has continued to increase. So that's just a good fundamental driver. And it's important for investors because central banks are actually pretty smart buyers. They mess up other things, but they're pretty good when it comes to buying gold. They don't chase the price, but they kind of put a floor under it. No guarantees, but they buy the dips, to use a cliche. Russia's a good example. They're very transparent. They would just put in a standing order, 10 tons a month or whatever. They didn't want to disrupt the market. But if they see a dip, they'll buy it. So you've got it's great for investors because you have all the upside. But the downside is kind of limited because the central banks will step in. So that's number one. Number two, good old-fashioned supply and demand. The supply has been flat for 7 years, around 4,000 metric tons a year, up a little bit, down a little bit. I'm not saying peak gold or gold output. There are no more gold mines that are out there, although they are getting harder to find and more expensive to mine. But demand keeps going up. So at least where I went to school, when demand goes up and supply is flat, the price goes up. That's how you make the market work. Institutional investors are dipping their toe in the water. And the thing to understand about institutional investors, now I'm talking about sovereign wealth funds, endowments, big mutual funds and so forth. Their allocation to gold is tiny. It's like 1 or 2%. You would think maybe it's 5 to 10%. It's not. 1 to 2% is the right order of magnitude. If they just went from, let's say, 2% to 3%, that's not like a huge move. But just going from 2% to 3%, the amount of dollars involved was so large that, I mean, there's not enough gold in the world at these prices. That's something that would shoot the price even higher. That's starting to happen. So, and then the fourth element I would list is, we still have the bombs and missiles, but a lot of 21st century warfare is financial warfare. And this a lot started with the effort of really the EU, but the U.S. was involved at the early stage to steal $300 billion of treasury securities from Russia that Russia bought them legally, made the money on oil, bought them legally, put them in a custodian in Brussels called Euroclear. But when the war broke out in 2022, those were frozen. That's to be expected. But Europe took steps to steal them and use them as collateral for a loan to Ukraine. So Russia would be financing Ukraine in a war where they're fighting Ukraine. It was a crazy idea. It seems to have died down, but it was out there discussed for years. Well, if you're Saudi Arabia or Japan or Taiwan or Brazil or any large holder of U.S. Treasury securities, you're looking at that and saying, hey, what if the U.S. doesn't like something I do? What if I'm on the blacklist someday? Maybe I ought to diversify into gold, and they're doing that. So you have, again, I'm not saying they're dumping treasuries. That narrative is not true. But as new reserves come in, they are buying more gold. So these are really fundamental things that are pushing the price up, and are going to keep it there.
Curious to really understand what you think is driving silver. Is it simply following gold? I mean, it looks way more than that from my perspective, Jim. Is it China driving the story? What are your inside sources telling you, Jim?
Well, China actually does like silver. They've been buying enormous amounts of gold. We've talked about that. But historically, China has always treated silver as a precious metal. In fact, until fairly recently, they settled their balance of trade in silver. And they like that. So they're part of it. But there's a lot else going on, and we don't know all the facts. But
Yeah.
there have been some supply disruptions in the London market, and the lady named Blythe Masters, she was the head of commodities trading for J.P. Morgan for a very long time. She's moved on to other things now, but she was referring to gold, but it applies to silver. She said, gold never settles. And what she meant by that was, if you look all the paper transactions, forwards, futures, options, unallocated, agreements, settled with banks, the amount of paper gold, but this would be true of silver also, relative to the physical supply, is probably 100 to 1. So as long as everyone's rolling the contracts over, not demanding delivery, etc., the market works fine. But the minute some segment of the market says, you know what, give me the silver, I want physical delivery.
Yeah.
All of a sudden, the commodities exchanges and the warehouses, the custodians are saying, well, wait, we don't have that much silver. They have to go get it. I'm not saying there's been a default, but what I'm saying is, all of a sudden, there's a scramble on the physical side to keep up with the paper side. You can never keep up with the paper side. It's way too big. So then you get into the dynamics of a short squeeze. So that's driving it. But I've said all along, I would buy gold and silver. I have both, and I recommend it to investors. And the question I hear a lot, Danielle, is like, hey, Jim, you said to buy gold when it was 700 or 1,200 or 1,300.
Yeah.
I didn't do it, etc. I've
Yep.
missed the rally. And my answer is, you missed $3,000, but you have not missed the rally. It's going to 5 and then 10 sooner than people realize. It's not too late to get in, even if you're buying gold at 4,500, which is about where it is today. If it goes to 10,000, you still double your money, and it could go a lot higher than that. I don't have to sit here and make $20,000 forecast, but if you said, is that in sight? Yeah. So yeah, you're a little late to the party, but the party is just getting going, and it's going to last a long time.